In today's presentation, we're going to be doing a fun topic talking about effective early retirement strategies. Now, early retirement means a little bit different, a different meaning for everybody. So we're going to clarify that here as we go through. But regardless of if you're already retired, if you're thinking about early retirement and really early retirement, there are going to be different themes, different ideas that you can take from this presentation to improve your retirement regardless of what age you are looking to retire at. So we're going to talk through a step-by-step framework for starting the best years of your life a little bit earlier, okay? Now, as you guys know out of every presentation that we have, our motto here is you don't need more money, you need a better plan. Well, the same, if not even more true, is the case with retiring early, okay? And again, the real message here is there is so much hidden value in so many people's plans that they're not tapping into, that rather than worrying about the next $100,000 that they can make in the market. Obviously, we want to make that within our investments and whatnot, but we can't control that. We can control the value that we take from our plan. And as we'll go through this presentation, I think you're going to really see this message come alive and how important planning is, specifically for those that are even retiring earlier than, again, the average age being 62, okay? So when we talk through early retirement, what are we generally talking about or focusing on in this presentation? Well, certainly a large part of the focus of this presentation is going to be those that are retiring earlier than 59 and a half. And again, everybody here has a different definition of what early retirement means. For some of you, maybe retiring at 65. If you have peers that retire at 70, maybe 65 seems like early retirement. For others that have friends and family and relatives and whatnot that retired at 60, maybe 55 seems early and 62 seems late. So everybody has a different definition. We're primarily going to be focusing on younger than 59 and a half, but talking about a lot of themes as well that will matter for those that are retiring, let's say even before 65 or even before they file for Social Security. So again, if you're in that camp where you're retiring, let's say at 64, that still might seem like early retirement to you. There's still going to be some themes that come out of this presentation that you can utilize for your retirement, okay? But primarily focusing on those younger than 59 and a half. So more risks show up with early retirement. And this really shouldn't seem like much of a surprise. Obviously, we all have an end date. We don't know what that end date is, but obviously the later that you retire, the less you're going to have to live off of your own assets. Okay, said another way, let's say that you're retiring at 70 and up and over Social Security, let's say you need about $20,000 and you have $1 million or $1.5 million saved up. Okay, well, obviously there are a lot less risks in that person's situation than somebody who's retiring at, let's say, 55 and now needs to bridge a gap of 15 years to get to Social Security if they're delaying Social Security, and then even after that. Okay, and so there are additional risks that show up with retiring early. That's not necessarily a negative that says that nobody should retire early. It's just that we need to be cognizant of those risks and make sure we're dealing with those risks within our retirement. Okay, for instance, early retirement, before you can start Social Security, for instance, or maybe before you can even start some of your pensions, by definition means you're living 100% from your savings, which can be a scary thing, which can be a difficult thing because we don't have a guaranteed floor. Again, for a lot of people, if you're utilizing Social Security properly, at the very least, even if you ran out of money, which is obviously a terrible thing, we want to avoid that at all costs. But if you've delayed Social Security and you're optimizing Social Security, at the very least, you still have a base that you can live off of, even if you mess up some different things in your retirement. Before retiring early, this gets a lot more difficult. We often say longevity is the amplifier of all of the risks. Now, when I talk about longevity, I talk about longevity in retirement. So obviously, again, if you're retiring at 55 and you have, again, normal longevity, normal life expectancy, you're spending a lot more time in retirement than somebody that's retiring at 65 or 70, let's say. And as we live longer in retirement, every other risk is amplified. We're going to see more market crashes that we have to deal with. Okay, we're going to see more inflation. Okay, we're going to see more tax and regulatory changes. Now, I met with a gentleman the other day that brought up a fantastic point. There's also more of an opportunity to compound interest and grow your wealth as well. And so that is 100% true as well. Longevity amplifies your ability to grow your wealth. So again, this comes back to the plan to make sure that you're overcoming the risks that you will face. Liquidity constraints is a huge one. How many people, when they start working and contributing to their retirement at, let's say, their 20s, are readily thinking about, okay, in 35 years, I'm going to retire, so I need to start planning in that way right now. again, we start to realize these things as we work. We get different promotions. We scale through our company. We start earning more, maybe more than we expected at certain times. And maybe we're able to save more. Maybe market returns are a little bit better, that our nest egg has gotten to a point where we're able to retire earlier than we might have thought. Well, the problem is so many people are locking up money in their 401ks, in other plans that have that 59.5 access rule, that retiring at 55, how do you access money that's tied up till 59.5? Again, you might have $4 million at age 55, but if you can't tap that money, do you really have $4 million? And again, you can tap it, but you take a 10% penalty doing so. That generally isn't wise to do. So that's a big one, especially for those retiring prior to 59.5. And then obviously healthcare costs, healthcare planning. Healthcare planning prior to 65 can get fairly expensive because the amount of money that you take, that you report to the government, raises your healthcare costs. And so there's a tug of war happening there where we want to retire while we're young. We want to enjoy our retirement, go travel, do all the things we can while our health span, and again, health span is slightly different than lifespan. Lifespan is how long you're going to live. Health span is how healthy you're going to be for that period of time. And so again, there could be an 85-year-old that's healthier than a 70-year-old. They have a longer health span. And so while we're looking at that health span with retiring early, okay, we want to be traveling. We want to be doing all of these things and living actively generally. And so that generally takes more money than just, sitting on the couch and having a more, calm lifestyle later in retirement. And so that causes our healthcare, our reported income, to skyrocket as well. So how do we navigate that? These are all these risks that we need to overcome. Now, the first question I want everybody to answer, that I don't think enough people put enough thought towards, is why or why not? And what I mean by why or why not is, why are we working? And why don't we want to work? Okay, so there are certain, and everybody's in a different category here. That's why they call it personal finance. It's a big portion personal, a big portion finance. Okay, but it is a big portion personal. I'm in a career right now that I absolutely love. Okay, I love doing these type of trainings. I love working with you guys. I love the community that we have here. This is something where I might want to ratchet down the amount that I work, but I can see myself working a very long time in what I'm doing. Other people, their work serves as a means to an end. They are earning their money, and that money is supposed to allow them to save for the future, so one day they don't have to work, and allow them to subsist right now. Okay, well, if you're in that camp, again, obviously early retirement makes a lot of sense, but what is the purpose of early retirement? What are you trying to gain? Does it have to be a wholesale binary option? Do we have to go from working a full-time job, earning quite a bit of money, to now all of a sudden not working at all? Or again, are we trying to retire early because we just don't like this job? There's too much stress, too much responsibility, and we don't like certain aspects. Maybe we don't like our coworkers, whatever it might be. We need to answer that question. I really want retirees in general to go into retirement with a lot more intention than I currently see right now. And that's a big message where we could probably host Whole Wealth Wednesdays on this exact topic. We might going forward into the future. But there are times where I meet with a given retiree, and I look at their situation and I go, well, you could have retired 2 years earlier. And they don't love their job. They're looking to retire tomorrow, next month. And so it can be really stinging to hear that, oh, I could have retired 2 years earlier based on the assets that I've accumulated. Other people, again, are going to want to continue working a little bit longer because they don't mind their job. So you have to answer this question, why or why not? What is the point of you trying to retire at the given time period? Because that's going to change a lot within your plan. It might adjust certain dynamics that we'll talk through later within your plan. But make sure you're answering that why or why not question. Now, there are two ways to brute force retiring early. Okay, we're going to talk about a lot more non-brute force, maybe what's the alternative word to brute force, whatever it is. We're going to talk about better ways to plan through strategies, but there really are two ways to just brute force retirement. There's growing a very large nest egg. Again, if you want to, Tony and I often talk, my business partner Tony and I often talk about, if you want to earn a safe $100,000, well, earn $200,000. Well, the same thing applies in retirement. If you want to have a safe retirement, rather than having $2 million, have $4 million. Now, you don't need $4 million necessarily, but that obviously is a brute force way to make sure your retirement is safer. The other way is to control your spending. You can control the amount that you have, or you can control your spending. It makes sense that, let's say we have somebody that's looking to take $50,000 and retire early, and they have $1.5 million portfolio. Okay, that person is in a better situation than somebody that wants to take, let's say, $150,000, but has a $2.5 million portfolio. Okay, so ratcheting down your spending, controlling your spending is another brute force ways. Now, there are ways that you can have your cake and eat it too. You can essentially retire with a reasonable nest egg and spend what you want, but it comes from having a better overall plan. So we're going to talk through a step-by-step framework from now on how you can navigate all of these risks, all of these things that you're going to face as we move through and forward into early retirement. Okay, so again, step number one, and I cannot stress this enough, I'll talk through some context on what I mean here, but you need a map. What I mean by a map, your plan, your retirement plan, a well-built retirement plan is the map that you need. Otherwise, we have a target out into the future. How do we know if we can reasonably hit that target? Okay, we need a plan. Okay, we need a map. Retirement is something that if you haven't retired yet, this is uncharted territory. You are going into a new area. And so going into a new area without a map, I think is ridiculously crazy. Again, this is even more important, again, when you're retiring early, when you have a gap until Social Security start, until other guaranteed income sources start. So what do I mean by a plan? Well, I urge everybody to have a plan that runs a Monte Carlo on your situation. The reason being is because if we just build one situation, one plan moving forward in the future, it's almost guaranteed to be wrong. There are too many things that are impossible to try to predict. Let's try to predict the market returns over the next year. If we took a poll of this group, majority of us would be way off, I'm guessing. Okay, and so how can we predict returns 10, 20, 30 years down the road? Well, we really can't, but we can use probability. We can use statistical significance to plan. That's why we run 1,000 trials, because we're changing those given investment paths in each one of those trials, so that we know the path that we end up following is probably pretty close to one of those 1,000 paths that we ran. And again, this needs to be dynamically updated each and every year. But if we ask the question, okay, I'm thinking about retiring at age 60, can I retire at 57? Well, go back to that map. What does your probability of success look like? Okay, well, here, let's say you have a 92% probability of success. Okay, that's a good starting number. Now, I'm going to talk through whether there's context for this probability of success. Again, what should we be aiming for a probability of success? That's also going to vary from person to person. But after we have that map, we want to put that map under stress tests. Okay, we're at a 92% probability of success. That's with whatever assumptions we initially uploaded. Let's say our initial assumption was assuming inflation was 2.25%. What happens if inflation's higher? We've seen very high inflation in the last year. So what happens going forward in the retirement if inflation's closer to 3%? Well, now all of a sudden we lose 10 percentage points, 10 probability of success points. And so again, these type of things are important as we start to have the confidence to retire early. Retiring early will lead to a lot of what ifs. Okay, what if I retire at 55? Market returns have been very good. What happens if they're terrible moving forward? And then you retire, and this what if cycle goes on in your head, and it basically ruins retirement, because now rather than worrying about an annoying job, about some annoying things at work, now you're worrying about, do I have enough money? And you're constantly stressed. Well, that's not a life to live. Okay, well, you can calm those what ifs through a better plan. Okay, stress testing that portfolio. What if I see a market crash? What if inflation's higher? What if Social Security's cut? What if I die early or live longer? How does that change my given plan? And then finally, adding context to that probability of success. Do not rely, if anybody's ever showing you a probability of success and saying you're at a 90% probability of success, you need to work longer because, again, do you want a 1 in 10 chance of failing your retirement? Well, no, I don't want a 1 in 10 chance of failing my retirement. So yeah, it looks like I do need to live longer. There's context to these Monte Carlos. So what I did is basically you can look at each given trial and look where the failures happened. And so what I did is I took trial 940. Again, we know 920 of those are successful. The other 80 at a 92% probability of success are failures. So what do those 80 failures look like? I just looked at 940. Basically what we see here is the average portfolio return for our expected return after balancing out that portfolio, and we're a little bit more conservative on average, was 7%. Well, notice in trial 940, what we see is returns are a lot lower than expected. Returns are at 2.63%. Now, when we're expecting 7% and we see a trial that's 2.63%, okay, we have to accept any level of risk. We have to accept a level of risk when we retire. Okay, nothing's going to be perfectly 100% probability of success. So if we're willing to accept that we have to accept some risk, for many retirees, we're willing to accept more risk than other retirees, which can lead us to not having to have a 99% probability of success. For instance, in my situation, okay, if I was looking at retiring early and I had a 92% probability of success with an expected return of 7% based on the assets that we have, and we've already been a little bit conservative with those asset assumptions. If I earn a 2.63% return on my investments for the next 30 years and I fail, I'm fine taking that risk. That is obviously a terrible trial there, where earning basically a little bit more than inflation causes a failure. Well, that's not that it's surprising. And so if we're willing to accept some of these failed trials, we can start moving this over and start to see, okay, maybe our probability of success is only an 85%, but if we're willing to accept the failed trials, if we think those failed trials are very unlikely, we have the confidence where we can retire. So we need to be adding context past just that probability of success. And this is what I mean by building a map. Okay, we've talked about in other presentations how building a map comes back to things like things like forward-looking tax planning, all of those type of things. I don't want to beat a dead horse on that subject. What I want to really talk through is the map will give you the confidence to retire early. With all of these risks that we'll face, we can put that map under stress test. So step 2 then is obviously if we're retiring early, as we originally talked about, we need access to our money. Doesn't matter how much money we have if it's not accessible. We need liquidity. So here's a hypothetical situation that I see retirees that are looking to retire early. One of these situations that they fail. So they stopped working at their job and they rolled out their money right away. Okay, and now they have a taxable account and a Roth IRA where essentially these are freely accessible. While the Roth IRA, only a portion is freely accessible. Basically, the contributions are accessible. Okay, the earnings are not accessible because of that 59.5 rule. So let's say they contributed, $40,000 of this Roth IRA, and then they have this taxable account that's obviously completely accessible. So they need to get to age 59.5, and they have 4.5 years to do so, to get to that point. And they basically have, combined with that example I just gave, about $140,000 to get them to 59.5. Okay, that's a very difficult situation. Now, we know they have a lot more money. We know they might have the money they need to be able to retire, but a lot of it's not accessible. Again, 59.5 rule, 59.5 rule. So what can this retiree do? This money seems to be tied up. Well, at this point, there's not a ton this retiree can do. Okay, prior to this, if they would have planned a little bit better, there's a lot they can do. So we're going to talk through a couple different ways that you can access funds prior to 59.5. A big one of those is the rule of 55. Now, there are some different ripples with the rule of 55, a lot of misinformation out there with the rule of 55. A lot of people don't even know about the rule of 55. Here's what the rule of 55 is. If you separated from your employer after the age of 55, or at the age or after the age of 55, you can access your company plan, whether that's a 401k or a 403b, and basically sidestep the 59.5 year rule. You can access as much as you want. There are no stipulations on that front, but it has to be from an employer that you separated after or at age 55. So a couple things that are often confusing here, okay? Most people think it has to be your exact last employer, meaning that let's say I had an employer I separated from at 55. I worked one more year at a different employer at age 56. I also have a little 401k balance there. A lot of people think I can't access that previous employer's plan. You can access that previous employer's plan as long as you have separated from that employer at age 55 or after. So you could stack up, again, you could probably have 3 different plans, and you could have the access to each one of those plans as long as it was after age 55 that you stopped working at that given plan. Public service workers can access as low as age 50. Okay, so that's, again, a nice little ripple for. We'll talk about public service workers are a prime candidate for early retirement just because of a few different things they have going on in their situation. Now, again, there are no mandatory amounts, no constraints, nothing like that. The only constraints are, again, that you have to have separated from your employer at age 55 or after. Okay, if you separated, let's say at age 53 and used a taxable account for 2 years until you got to age 55 and you think you can use the rule of 55, you cannot. Okay, so I've seen a lot of horror stories where somebody retired early thinking they could use that rule of 55, but couldn't because they retired earlier than 55. Okay, so and you don't really need to retire; you just have to have separated from that job as well. Okay, so again, rule of 55, is allowed for company plans. This does not allow, you can't access, let's say, a rollover IRA and use the rule of 55. Only company plans. Again, this creates a ability in the IRS code, but 401ks do not have to use or do not have to allow for the rule of 55. So you might be IRS rule able to use that rule of 55, but if your 401k does not allow it, because it takes obviously a little bit more administrative work, you're kind of SOL on that front as well. Okay. Another one that's available more widely is something called a 72T. Now, there are a lot of different variations in a 72T. I'm not going to dive too in depth. I'm going to talk basically from a bird's eye view here about a 72T, but it's a way to access funds even prior to 55. So you can access out of 401ks, 403bs, 457, TSPs, as well as IRAs. So most tax deferred accounts. And basically the only kind of stipulations you have here is it is scheduled payments. You do have withdrawal constraints. You do have a mandatory amount that you need to withdraw here, but you can start a 72T much earlier. Now there are 3 distribution options: a minimum distribution option method, amortization method, and then an annuity method. Each of these have a varying distribution amount. Again, use experienced help here. When there is a given distribution amount that you have to take that given amount each and every year. If you don't, you will break that 72T rule, and there will be 10% penalties that you are subject to. This can, again, be a way where you can access some of your money. I often find that a 72T is not large enough to completely replace income, so you still need further ways to access funds on top of this, but can allow for access prior to 59.5. Another big one that takes a little bit more planning ahead of time is Roth laddering. So we know with a Roth IRA, when we have money in a Roth IRA, we have a 59.5-year rule for accessing the earnings. We can access the contribution at any point in time. We could contribute next year or this year and take that money out next year without penalty, without tax. Now, the other Roth IRA, the earnings are not accessible until 59.5. But we can do a Roth laddering strategy, perform Roth conversions on a laddering basis, and have access to funds prior to 59.5. Now, the rule that we need to be cognizant of when performing a Roth conversion laddering strategy is prior to 59.5, you have a 5-year rule for Roth conversions. Okay, it's either the greater of 5 years or until you reach age 59.5. Once you reach 59.5, that Roth conversion is freely accessible. Okay, so we can start to see how a Roth laddering strategy can work then. Okay, so we know if we're trying to retire at age 55, we need to start to have freely accessible money. We need to start a laddering strategy prior to age 5 years prior. Okay, so if we're doing a conversion, okay, we can access money from a conversion 5 years ago that we performed, but a conversion 4 years ago, 3 years ago, 2 years ago, 1 year ago, and a conversion this year is not accessible until we pass that 5-year mark. And again, that 5-year mark is waived after you reach age 59.5. So if you performed a conversion at age 58, it's not the 5-year rule, it's now the 1.5-year rule, if you will, until you can access that. Now this, again, provides, it demands that you plan ahead of time, but can be another great way to access funds. And this also works into some of the other hurdles that we're going to talk about later for healthcare planning as well. But here's how this works. Again, Roth conversion today, the full amount is locked within within these 5 years of the conversion, if you will. Okay, after that 5 years, it's fully accessible. The amount is you can take as much as you want. Now, there's a stacking rule with Roth IRAs that the money you take out first is going to be considered contributions and have no penalty. This is optimal. Okay, the IRS will do this essentially for you in a way. The second amount that you have to take out or that is taken out is conversions next. It'd be first non-penalty conversions and then penalty conversions. Then finally, earnings would be taken out last. So again, you don't have to decide which amounts you're taking out of. If you have money free from that 5-year conversion, after that 5-year conversion, you can take that money out and it'll be, again, penalty free. So we can start to see how this is strategically used. Again, for those that are retiring early at age 55, let's say you don't have access to the rule of 55, you don't want to do a 72T for a number of reasons. Well, you can perform a Roth conversion ladder prior. Now, again, you just need to plan ahead, make sure that you're performing that conversion 5 years prior to when you need it. This can help you bridge the gap between age 55 and age 59.5. It can also provide you money where you can earn a large subsidy for healthcare because, again, Roth money is not counted against you for reported income. And so this Roth conversion ladder, you will have to pay taxes on the conversion. with every conversion, you have to pay taxes. You are paying taxes today to try to avoid higher taxes down the road. Oftentimes, again, this can make sense for those that are early retiring or retiring early, but you have to plan ahead of time, okay, for that 5-year rule. And this can help bridge the gap in a great way for a lot of retirees. Here's another big one where we're going to go a little bit more in depth and talk through what I think are a lot of broken principles with retirement planning. So here's what you'll often see is the power of tax deferral versus a taxable account. So you'll see things like on the screen, like what you'll see things like what you see on the screen right now, where they show just a very simplistic chart of why you want to contribute to your traditional IRAs, your 401ks, things like that, versus a taxable account. Obviously, with a taxable account, we're paying taxes. We're then investing in a taxable account. Anytime there is a tax change within that given account, we buy or sell an investment, there might be a taxable event. So you can be taxed on an ongoing basis is really the big message here, why everyone tells you to put money in tax deferred accounts. They're not telling the whole story. What I mean here is tax deferral over 20 years, $100,000 initial investment, 8% rate of return. They're basically assuming a 28% overall tax rate. So June here is getting a tax deferral where she's not paying that 28% tax rate. Whoever, Joe here, is paying taxes at 28% and then investing in a taxable account. And guess what? Not surprisingly, there's a gap here. 52% more money in growth in tax deferred accounts. Well, yeah, no kidding, because this tax deferred account is pre-withdrawal. So they haven't paid taxes. Joe's money here is after tax. Jane's is pre-tax. Of course, there's going to be more money when you don't pay taxes. Okay. And so this is commonly, I see this time and time again. Okay. There are times where you do want to contribute to tax deferred. I'm not saying you never want to contribute to tax deferred. What I'm saying is most people would benefit more from having a diversified tax bucket than they would only contributing to tax deferred and having money locked up. Again, this taxable account specifically for retirees, early retirees, is freely accessible. So let's dive a little bit deeper into this. We're going to introduce a new concept. We've introduced this concept a few times before on our Safeguard Wealth Management YouTube channel in some of our smaller videos. This idea of tax equivalency. So all the time I hear objections around if you pay taxes today, that's money that there's an opportunity cost on. That money could be earning interest and growing. So that tax money that you pay today could be a lot larger. And when you pay it down the road, it's going to be smaller. That's not the case. Okay, that's a miscalculation in tax planning. Okay, when we're paying the same exact rate, we're in the same exact scenario. So we have two scenarios here. We have basically putting money in a tax deferred account versus a Roth IRA. Obviously, the Roth IRA, we pay taxes right away. Tax deferred account, we pay taxes over time or whenever we withdraw that money. So 6% growth rate, 22% tax rate is what we're comparing. We're looking at a marginal rate. I realize that you would be paying taxes, at first in 10, 12, 22, etc. We are looking at just trying to make this example so it's apples to apples here. 22% tax rate. And basically what we see, $100,000 starting out. The Roth IRA, they paid taxes right away, 22% in taxes, and now they're only investing $78,000. So the majority of these years, it's going to look like the Roth IRA on paper is behind. Well, yes, because they've already paid taxes. This is money that's tax-free. It's after tax amount. Over here, this is a mirage, okay? $179,000 is pre-tax money, okay? So there is a tax risk hidden in this tax deferred account here. Well, when we take out 22% at the end to show after tax amount, guess what? We have the same amount of dollars. So it doesn't matter when you're paying taxes if you're paying the same exact rate. Okay, they will be equal situations. This is the idea of tax equivalency. Okay, if you're paying the same exact rate, you will have a tax equivalent event. It doesn't matter. It depends what what Joe or Jane paid at the front end, what they're paying on an ongoing basis, and then what they paid to withdraw. If you're retiring before 59 and a half. And so speaking of my situation, I'm building a lot of wealth over here in this camp. I'm also building wealth in each of these other camps as well. Because again, we want tax diversification. We want to patch the leaky buckets of a taxable account. And we also want, again, there are going to be points where if we're paying taxes in the 32% range, 35% range, our marginal rate, then a tax deferred account does start to make sense. But for a lot of people, having diversification in these buckets makes more sense. Okay, so that's talking through accessing the funds. Then we have a couple different ways we can do so. big message I would have for those that are younger, start thinking about Roth conversion ladders, start thinking about contributing to a taxable account. For those that are already at that age where they are needing solutions prior to age 59 and a half, use things like the rule of 55 and 72 T's. And hopefully you have some other accounts that you can also pull from and access those funds that you've worked so hard to accumulate over the years. Okay, step number 3 is overcoming all the different planning hurdles that show up prior to, later in retirement, if we would retire later in retirement. A big one is Social Security. As you start building plans, okay, the longer of a gap that you have until Social Security starts puts a lot more stress on your portfolio. And this makes sense if we think about it. If we're delaying Social Security, or even if we're taking Social Security at full retirement age, 62, whatever that age is, the amount of years we have before Social Security starts, we're having to fund all of our retirement from our given assets. Okay, so let's say we're delaying Social Security to 70 and we're retiring at, let's say, 58. We have 12 years where we're going to have to live 100% from our retirement assets. This changes a lot of things within our retirement plan. It puts more stress, puts more risk within our retirement plan. This is not to say that that makes it impossible. We all have to retire right before Social Security begins. It just means that we have to overcome this planning hurdle within our portfolio. Okay, so what do I mean by this? And this is going to vary widely. This is not a all the time example. This is just one example I took from somebody that we built a plan for that was retiring early. We noticed that before Social Security started, their withdrawal rate would drift between 4.5% to 5.3%. Now we know safe withdrawal rates previously have been thought of around 4%. Again, we posted videos where I think the 4% rule is kind of a terrible rule, all things considered, but nonetheless, let's go off that. Obviously, the higher our withdrawal rate, the more stress we're putting on our portfolio, the more risk we have of failure. Notice after this person got to Social Security, their withdrawal rate was completely palatable. Okay, they're again taking, let's say, 1.3 to all the way up to 3%. Even a poorly built retirement plan can sustain those given withdrawal rates. It's this right here. How many years are we going to be taking this given withdrawal rate? 1 year is not a big deal. If we're retiring at 69, taking Social Security at 70. Retiring at 58 and taking at 70, all of a sudden now, again, we have different things that we need to be thinking about here. This puts more stress on our portfolio. So what does that mean? Well, we talk a lot within our planning about the way to build a better investment plan is not through picking better stocks, not through giving money to a fund manager that's going to outperform the market. It's through portfolio construction. The math changes when you're retired. You are no longer accumulating and dollar cost averaging in, you're dollar cost averaging out. And so the math changes. When you're in the accumulation phase, you can stay very risk heavy. Two things that matter, your savings rate and your growth rate. Okay, the better those two are, the more money you will have accumulated entering into retirement. All of a sudden, when you enter retirement, it's not just about the growth rate. We need safety. The reason being is because losses hurt us more than gains help. We'll talk about this in a sec. But basically what I'm showing here is I'm showing a 5% withdrawal rate on $1 million portfolio. So this is trying to simulate if somebody had to spend, let's say, 15 years. They're retiring at 55 and delaying Social Security to 70. So they're having to take a 5% withdrawal rate, inflation adjusted, moving forward into the future from their assets. Now, if they're completely stock oriented, again, this is actually looking at historical performance from 2000 until 2015, the first 15 years, which again was a very negative first 15 years, but nonetheless, we've seen it happen. This person retires at 55 in 2000. If they're stock only, they saw their portfolio from when the time that they bridged that gap to Social Security drop from $1 million down to $150,000. Okay. And again, you can multiply these numbers. If it's a $2 million portfolio, if it's $100,000 they're taking out, that doesn't necessarily matter. It's more the concepts here. Versus a diversified portfolio that we are expecting a lower return from than stocks actually does better because it has that balance of safety and growth. We know as a retiree, especially an early retiree, you need growth to overcome things like inflation. But you also need safety because if we see a 2008, 50% drawdown, okay, if we're pulling from our assets during that time, we are furthering that drawdown. We're taking income, yes, but from a portfolio standpoint, that is an additional loss. Okay, we are dollar cost averaging out. So all the benefits of dollar cost averaging are now working against us. So we need diversification. We need safety. We need a balance as we enter retirement. Okay. For those that have done really successfully in accumulation, that can be a hard thing to kind of change our mindset for. An 8%, 7% return might be better than a 10% return. Okay. And so the reason for this is the mathematical impact of losses. When we've lost 50% in a 2008, we need to make 100% to get back to break even. We need to double our money. Well, what happens when during that long drawdown, we've been taking from our assets? It's a 2-year drawdown. We've been taking 5% from our assets. Now we're at a 60% drawdown. That's only 10% more, but now we need an extra 50% on the way back up. So the math doesn't work anymore. Okay, we've just permanently hurt our portfolios by being too aggressive. Okay, this is very important for those that are retiring early to have a better portfolio constructed, because those first 10, 15 years, however much it's going to take you to get to Social Security, is going to define the rest of your retirement. Okay, there's a lot of, again, risk put on that initial period. Okay, overcoming planning hurdle number 2, which is healthcare. Now, there are 2 rules that we're going to need to plan under based on when you're retiring. For 2021 and 2022, we're planning under the American Rescue Plan. COVID plan, CARES Act put in the American Rescue Plan, which changed ACA insurance. Okay, so healthcare options for those that are retiring prior to 59 and a half, or really even retiring early, prior to 65 even, you have to choose from a couple different options that you might have. COBRA insurance, typically that's 12 to 18 months that you have unsubsidized insurance from your work, typically quite expensive, but you know what you're getting. Okay, you can use the same providers you just had while you were working. ACA insurance is a big kind of question mark, because again, you can basically have next to no cost insurance here if you report a low enough income. If you're using strategies like a Roth laddering strategy, where the majority of the income you're taking is from Roth IRAs and thus not reported income, or if you're taking only from the rule of 55, taking from tax deferred accounts, this might hurt you quite a bit, because you'll have unsubsidized insurance because you show too high of an income. So that's a big kind of variable that we can either decrease that cost, or depending on what we have access to our funds, that's a very high cost. And then there's something called health sharing. Typically this is associated, but not always, with religious organizations, where they essentially pool together a sum of people, typically have to have reasonable health to join one of these organizations, but they can essentially use a more group plan, if you will, and get lower healthcare costs and not have that reported income thing, the reported income threshold that we need to stay under. So again, there's always a tug of war between taking the income you want, but making sure you report a low income. Now, for 2021 and 2022, you get a lot more room to report an income, higher income, and show or earn a subsidy. The reason being is because these proposed changes are actually the changes. And what you'll see here is prior, there was a healthcare cliff. So at 400% of your federal poverty level, once you went over that, you lost your subsidy altogether. And so this cliff right here was a very costly cliff. You didn't want to go over that cliff. Prior to that, again, your healthcare costs increased in more of a linear basis. Now we have more of a hill rather than a cliff. Notice your costs increase linearly for the first portion, but once you're over that 400% poverty level, your subsidy wanes out at basically an 8.5% rate. So every dollar you take, whatever tax rate you're paying, you have an extra 8.5% because because you're losing a subsidy during that time. So we don't know what's going to replace if we're going to go back to the old rules. That's what we are looking at right now, going back to the old healthcare cliff for 2023 and beyond. For the next 2 years, you have, or last year and this year, you have a much more room to report a higher income. Okay. Nonetheless, though, this can get fairly complicated. There's a lot of things that are included in your reported income. You don't get to use your taxable income. That would make too much sense. Use something called healthcare modified adjusted gross income. This includes all wages and distributions from taxable accounts, or from any account that has that creates a taxable event. So wages from your job, part-time job, distributions from an IRA, all of those type of things. All of your Social Security benefit, even untaxed. This is why, again, it's very negative to take Social Security at 62, obviously for all the reasons just pertinent to Social Security, but healthcare costs can also skyrocket when you're taking Social Security too early as well, because it's all counted as reported income dollar for dollar. Pension and annuities, capital gains, passive income, unemployment benefits, interest, all of these things count against you. You don't get to take the standard deduction either. So if you have a $90,000 income, adjusted gross income, you don't get to take the $25,000, whatever it updated to in 2022, a standard deduction. Okay. And so again, this just shows it's from the finance buff. He's got a couple awesome, great charts. Basically shows your tax credit by income. This is for 2021 and 2022. Again, it's more of a slope. You can show a much higher income than you previously could. Previously, you could only show an income in that, again, depending on how big your household size was, somewhere in the $60,000 range. Now you can show a much higher income all the way into that $140,000, $150,000 range. You'd still earn a little bit of a subsidy, but notice the subsidy does wane out in time. Okay, the more income that you show. The other thing that you need to overcome, which is why we need the growth, which is why I didn't say that you can only have safety with portfolio construction. We need the growth to outpace things like inflation. Inflation's top of mind right now. Okay, last 2 decades, it's been around 2 to 2.5%. We're seeing inflation rates in the 5 to 6% range right now. Okay, we can see $75,000 grown for 40 years at varying inflation rates here, 2, 3, and 4%. Notice what happens at the end. Over time, this gap diverges even more. Okay, the gap gets even larger. By the time we hit later in retirement, if we were looking at a 4% inflation rate on 75 grand, by year 40, we need over 350,000. At 3%, we need about 250,000. If we're only assuming 2%, we need, what is that, about 160,000? So these are wide gaps that grow over time, which is why we need growth within our portfolio. We can't just invest in things like CDs that are losing to inflation. We can't invest in things like bonds that are losing to inflation because we are lowering our purchasing power, not growing our purchasing power. We need to grow our purchasing power. We need income raises through time. That's another hurdle. And then finally, the other planning hurdles are a lot of the same planning hurdles that most retirees see. That if you're retiring at, let's say at 65, those same hurdles. Obviously, here we have the early retirement hurdles, healthcare, access to funds, again, inflation, things like that. Over here, we have a lot of other hurdles, tax planning hurdles. We see RMDs over here are way above this person's income need. This is very bad. And so, again, there has to be a give and take. There are ways that we can deal with the hurdles we'll see over here. We can deal with some of those hurdles over here with Roth conversions if we just forgo a subsidy. That can make a sense for certain people while we're in the Tax Cuts and Jobs Act. For other people, it doesn't make sense. Okay, so making sure that our plan, both early retirement and later retirement, fits together. That's another hurdle that can be difficult to navigate. But we can navigate each of these hurdles with better planning, building a better investment portfolio to overcome that the risk of loss while we're living entirely off our portfolio. We can earn a subsidy if we plan ahead of time and have access to funds that report a low income. And again, save $10,000, $20,000 a year on our healthcare costs. So all of these can be overcome with a better plan. Okay, again, coming back to that big message from the start. So step number 4, finding solutions. Okay, the first solution is essentially finding those solutions that we've talked about thus far in this presentation so far. You have a nest egg. Gain more from that nest egg from better planning. Find the puzzle piece that fits into your plan. It takes you from, let's say, an 85% probability of success to a 95%, if that's what works out in your plan. Or it takes you from a 75% to an 85% by utilizing strategies that are available to those that are specific to early retirees. Okay, so that's one that we've kind of been talking about, so I don't need to kind of reiterate those on an ongoing basis. There's also some alternative solutions. So for those that are in certain careers, they cater heavily to early retirement. What are some of these careers? Well, federal employees is a big one, where a federal employee might have a pension, they might have a healthcare solution with FEHB that's easier, that doesn't control, that we don't have to report a low income, that's relatively low in terms of costs prior to age 65. Even after age 65, a lot of people still stay on FEHB. Okay, pensions are another big one. Okay, a lot of these people have pensions from the federal government that allow them to span those years where rather than Social Security, they have that pension that's guaranteed, that's reducing the stress. They also have earlier access to company plans as soon as age 50. And then they also sometimes have pension options where they can increase their pension before age 62 as a buffer, if you will, from let's say 57 to 62. They have an increased pension to, again, reduce the amount of strain on their portfolio. So if you're in one of these careers, guess what? Early retirement is probably a lot simpler than you might think. Make sure you still have that experience help to assess whether the pension option makes sense, assess again, whether you should how early you can retire and all of those different things that, again, we've talked about thus far, but certain careers do cater to early retirement. Okay, a couple other alternative solutions are come back to that why or why not. So why are we trying to retire early? Are we trying to retire early because we want complete control over our freedom or over our time? We want complete freedom. We want to basically be able to live a month at a time around the world and experience new things. Okay, well, that's a different solution than somebody who absolutely just hates their job, that doesn't want to deal with the stress, that feels like they've accumulated enough that there might be some solutions that they can work on. Okay, there might be a situation where there's a gap into when how old one spouse is versus another spouse. And so if one spouse generally likes their job and one spouse absolutely hates their job and maybe is a little bit older even or younger, it doesn't really matter. One spouse can retire and one spouse can work a little bit longer. Notice if both of these people retired early, their probability of success would be a 76%. One spouse working 4 more years brings them to a 94%. So again, small changes because that one spouse that's still working is covering their income need. So essentially that other spouse, they won't be contributing as much to retirement accounts, but they can live off that spouse that's still working, their income for those years and bridge that gap. Another one is rather than one spouse continuing to work, certain people want to, hey, if I'm retired, I want to retire with my best friend. Okay, I get that, 100%. So again, what's the goal of retirement? Is the goal of retirement to replace a 9-hour-a-day job with less work, but still some work that might, again, still offer some things to do? Because again, going from 9 hours a day to now 0 hours a day for work obligations is a big step in general. I think most people are much better rather than kind of jumping into that next phase of their life, stepping into that next phase. And so something that might look like that is essentially straddling working and not working, which is part-time work. Okay, going from a job that you might be earning quite a bit more on to going to it from a job that's more part-time, more fun, that will replace some of that income. Again, brings them to a 91% probability of success. So there are all these different changes that can help bridge these given gaps. They go from working 9 hours a day to maybe on average 3 hours a day, 4 hours a day, or working only, Tuesday, Wednesday, Thursday or something like that, and having more of a longer weekend. All of these variations are possible as long as we see the plan and the ability to do some of these. Step number 4 finding solutions is dynamic withdrawal rates. Now, there are downsides to this. I would have a word of caution here where basically dynamic spending means as we start to step through retirement, we want a floor for what we at the very least need to spend to cover our basic living expenses, let's say $50,000, but we might want to spend up to $80,000. So we have that floor and we spend up and above that based on how well our portfolio does. If we see the last 5 years, over the next 5 years, that might lead to higher spending where you start at 50,000. There's a good year like this year where market's up, 27% in 2021. And all of a sudden now we can increase our spending to, let's say, 60,000. Okay. And so this dynamic spending, as we start to see returns look better, we can increase our given spending and have more confidence of bridging that gap. If we see worse returns at 2008, well, guess what? We're living off that $50,000. And so where I say there are downsides to this strategy is essentially you have a variable income at that point again, which some people can deal with just fine. Others have more difficulty where they want to have, when they retire, I want to know my retirement is set. I want to know that I can take the income I need. Otherwise, what the heck's the point of retiring? Okay, so again, why or why not? There are different personal elements that we need to be considering here. But the big message here is plan. Okay, you need that map. Everything comes back to a better plan. Okay, every different obstacle that we covered here can be not necessarily fixed with one simple solution, but through a better plan, through a holistic, multivariate solution, we can overcome a lot of those given obstacles. So everything comes back to the plan. The big message here is, what is the point of all the money that we've accumulated? Okay, for a lot of people, it's to enter the next phase of their life of retirement, those golden years that they're often referred to. But a lot of people have fear around that. And I completely understand that fear. You've gone from 40 years of working to now crossing over the chasm where you're going to be living 30, 40 years from your own assets. Okay, I get it. I get why there's a lot of fear there. It all comes back to the plan. Okay, if our goal in retirement is to live a certain level of income and pass a ton of money on to the next generation and have a very high probability of success, that is a different goal than somebody whose their goal is to use their money. They don't want to pass as much of an inheritance on. They can likely retire a lot earlier than that other person, or retire with a lower probability of success because they want to live off their income. They don't want to live, or they want to live off their assets. They don't want to leave a ton to the next generation. So what is the point of this money that we've saved? What are we trying to accomplish with it? Okay, we need to be very clear on that before we start building that plan. But as you can see, by building a better plan, there's a lot of effective early retirement strategies that we can use to bridge the gap towards Social Security to those later years in retirement. A lot of obstacles to overcome. Totally possible to overcome those obstacles based on your situation, what you're looking for. So always remember, and hopefully it was, again, apparent within this presentation, you don't need more money. You need a better plan. Thanks for watching. Hope everybody is having a great start to 2022. We will see you in next week's Wealth Wednesday. Thanks for attending this Wealth Wednesday. If there are any questions below, whether you're watching in our Facebook group or on our Safeguard Wealth Management YouTube channel, put those in the comments below. If you disagree on any points, let us know. We love feedback. And also, if you like this video and you're on YouTube right now, hit the subscribe button down below, hit the like button. It helps other retirees find this video just like yourself. If you absolutely hated this video, do me a favor, hit the dislike button twice. Thanks. Bye. Well, maybe not bye yet. I got to figure out how to turn this off. All right. Thanks, everybody. Have a great rest of the day.